every month I like to take a little more time and explore multiple topics that I think are critical for all of us for our success as we're preparing for retirement. And in today's video, I'm going to talk about 5 topics. The first one is, how much are we saving and how do we compare to others? It's easy to beat up on ourselves, but I bet many of you are going to look at this data and say, you know what? I'm doing better than I thought. The next report is my take on a large corporation's report that basically says it's going to be very hard for most of us to retire. And those of us that do get to retire are not going to have a very comfortable retirement. And you know what? I call bunk on that. And so we talk about that in the video. The third one really relates to, as we build up our net worth, that's a good thing, but we also become targets for scammers. And remember, Azul's first rule of money management, I borrowed this from Warren Buffett, is don't lose money. And the second rule is never forget rule number 1. And unfortunately, if you become victim of a scam, you can lose a lot of money very quickly. These scammers are getting more and more sophisticated. I want to make sure that these scams are on your radar screen so you don't fall victim to it. The next video that we're going to talk about, the next topic, is a very common age and net worth amount that people are saying, hey, do I have enough money to retire? So I'm going to use a free online tool. You'll be able to look over my shoulder and see how, as a financial advisor for over 20 years, I look at that situation and maybe some tweaks that this person can do. And I think we can all learn from that experience. And then finally, we're going to wrap up with what things should we be thinking about now? And as I record this, the market's at an all-time high. What things should we be thinking about today? That's easier to do when the market's at an all-time high than at any other time. So 5 really important topics. Half of my viewers watch my videos on television. If that's you, sit back, relax. I hope you find these videos helpful, informative, and also hopefully a little entertaining. I'll see you in there. Bye-bye. So what net worth does it take in order to be considered wealthy in the United States? You know, we're super fortunate because there's 2 studies that directly address this question for us. Let's jump into the first study. And it's done by Charles Schwab every year, and they call it their Modern Wealth Survey. And they simply ask 1,000 households, what net worth does somebody need in order to be considered wealthy? But then interestingly, they follow up and say, do you personally feel wealthy? And if so, what's the net worth of your household? Now, I want to define a couple terms here. What is household? Household is if there's one person living in a house, that's the household income, the household net worth. But if there's 2 adults living in the house, it's the combined net worth of both adults. So it's household income, household net worth, not individual. And then secondly, what is net worth? Net worth is simply the value of your assets minus the value of your liabilities. So for most of us, if we own a home, it's the value of our home, it's the value of our car, it's the value of all of our retirement accounts, the money in our bank account, etc., minus the value of our liabilities, which again, if you own a home, for most of us, that's going to be you subtract out your mortgage, subtract out your car payment if you have one, any credit card debt, any other liabilities that you have. So net worth is simply your assets minus your liabilities. So what did Schwab find? They found that the average home felt that you needed to have a $2.2 million net worth in order to be considered wealthy. But the second part of that question, do you personally feel wealthy? Almost half, 48%, answered yes to that question. And to me, that's very encouraging, particularly given that the average net worth for the people that answered yes was $560,000. So a far cry from the $2.2 million that they would say that people need to have to be considered wealthy. So to me, that's a sign of us being grateful. I think we as a society are grateful for the position we're in. You know, it's easy to covet. It's always nice to say, well, gee, I'd like to be like that person. But, you know, that's a path to unhappiness. And most of my viewers are older. And so we've learned that lesson. So I think that's a good thing that shows up. It's also consistent with a study that the Federal Reserve
does. That's called their SHED study. And the SHED study stands for their Survey of Household Economic and Decision Making. And you can see in that study, over the last decade, we tend to feel more comfortable in our financial security. Almost 3/4 of us report feeling comfortable with our financial security. Now that's down from 2021. It almost reached 80%, which is wonderful. And now it's 73% as of 2022, the latest SHED data that we have. And I think that just reflects the fact that it's getting harder, right? Expenses are higher. Wages haven't kept up with inflation. So it's definitely getting harder. But I do think it's great that, almost 3/4 of us feel that we're financially comfortable. And I think that's a wonderful thing. Having traveled to many countries, I can tell you that's not consistent throughout the world. I mean, there are regions, Europe, the United States, Canada, United Kingdom, Australia, but much of the world does not feel financially comfortable. In fact, much of the world doesn't have a retirement plan. Their retirement plan is their kids, right? And so we're fortunate that we can be in a position where we're saving up money, hopefully to be financially independent of our kids as we get older. And that's a big part of my channel, right? Is helping people reach that. But then also once you get there, helping people cross that bridge from working into retirement. Because as I've said before, if you're 60 years old, unfortunately, most of us are going to have less than 1,000 weeks of healthy active time. Okay. But I'm digressing. Let's jump in. I want to talk about the second report, which is done by the Federal Reserve, and it's called the Survey of Consumer Finance, where they actually look at the actual net worth for people in retirement. And here I want to share, they look at the age group, so I'm going to break it down by age group, and they look at average net worth, and then they also look at median net worth. And I want to explain why this is so important because it's critical. What's the difference between average and median? Average is really skewed by a couple high earners, a couple people with big savings. Let me give you an example. Let's say you're in a family with 5 siblings, and you're the middle kid, you're number 3, and you and 3 of your siblings each make $50,000 a year, right? So the average is $50,000, but the median, half above, half below, is also $50,000. Now your brother named Jeff may or may not have the last name Bezos, comes in and he's worth a lot of money, but just for the sake of argument, let's say he's worth $800,000. Now your median, half above, half below, you're the middle child, right? You and your three of your siblings make $50,000. So the median hasn't changed. But because your brother Jeff's here, now all of a sudden the average has jumped up to $200,000 each. Jeff makes $800,000. You and your 3 siblings make $50,000. Totals to $1 million divided by 5, $200,000. So it's a big difference. So I'm going to talk on this video about the median. I'll also put in the video so you can see in the table what the average is. Okay, let's jump in. For ages 20 to 24, the median net worth is $10,800. For 25 to 29, it's a little over $30,000. For 30 to 34, it's a little under $90,000. For 35 to 39, it jumps quite a bit, $141,200. For 40 to 44, it's $134,730. For 45 to 49, it's $212,800. For 50 to 54, it's $272,800. For 50 to 59, it's $320,700. For 60 to 64, it's $394,000, just a little under over $394,000. For 65 to 69, it's a little under $400,000 median net worth, $394,300. 70 to 74, it's $433,100. And then for 75 to 80, the median net worth is $316,000. Now, I want to say a couple things. A lot of folks say, I don't think I have enough money to retire. And, one of the things this shows is that end up 75 to 80 and the median net worth is over $300,000. So I think my industry has maybe scared people into thinking that they don't have enough money to retire. And you definitely want to know for sure if you have enough money to retire. But one of the takeaways from this survey is you're probably closer to being able to retire than what you think. And I encourage you to work with a fee-only financial advisor to find out how close, whether whether you can make that transition and retire sooner than what you think. Okay, but now I want to go into what does it take to actually be wealthy in the United States. First, I want to go through the median net worth by age, and we just went through that survey, so I'm showing that study up here. It's done by broader groups. Under 35, it's just under $40,000 the median net worth. 35 to 44 is $135,000. Again, this is median, and it's for households. So if you and your spouse, you and your partner live in the same household, it would be considered the two of you. But if you're single, it would be considered your net worth. Okay. And then 45 to 54 is a little under $250,000. 55 to 64 is $364,000. 65 to 74 is $410,000. And 75 plus is $335,000. So $250,000. But now let's look at what does it take to be in the top quartile and then the top 10%. So let's look at the top quartile. So you're in the 75th percentile. You're above 75% of the people. And again, this is median net worth by household. And less than 35 years old is a little over 150,000. 35 to 44, it's a little over 400,000. 45 to 54, it's a little over 800,000. 55 to 64 is a little over $1.1 million. 65 to 74 goes up just a little bit, closer to $1.2 million. And then 75 plus is just a little less than $1 million, $975,000. So that's to be in the upper quartile. And I think it's fair to say, yeah, you're in the upper quartile, you're wealthy. So this is what the numbers would show you actually need to have to be in the upper quartile. And you can see it's less than that Schwab report that I talked about earlier, where people said you needed to have $2.2 million. And there, I think they were really thinking more about the top 10%. And that's what this chart's about. For the top 10%, again, household net worth. Net worth is just all of your assets minus your liabilities. This is more consistent with the Schwab number. So this is actual net worth. So under 35, if you've got a little over $370,000 of net worth, you're in the top 10%. I should mention these are all numbers for the United States. It's done by the U.S. Federal Reserve in the Survey of Consumer Finance. 35 to 44, it's a little over $1 million, $1,050,000. 45 to 54 is just under $2 million, $1.974 million. You can see pretty close to that $2.2 million that the Schwab survey said. 55 to 64, to be in the top 10%, you need to have a net worth of almost $3 million, $2.96 million. 65 to 74 is just a smidge under $3 million. It does go up from their younger cohorts, 55 to 64. $2.997 million. And then people start spending their money. And so that median for people 75 and older is just a smidge under $2.7 million, $2.699 million. According to one of the country's largest and most respected custodians, Vanguard, you and I are never going to be able to retire comfortably. This is according to their most recent study, which is called the Vanguard Retirement Outlook, a national perspective on retirement readiness. And while there's some good information in this report, frankly, I don't understand why they're taking the angle that they are, which I think is unnecessarily scaring a lot of people. Vanguard was started by a gentleman by the name of Jack Bogle, who passed away. Jack did a lot of great things for the investment industry. And frankly, I think Jack Bogle would be rolling over in his grave if he read this report. Like I said, there's some good stuff that's worth us taking away from this report, but I don't think you need to be as alarmed as the report title says. Okay, so what's going on here? So what Vanguard looked at is said, what percent of your current income do you need to be able to replace in retirement? And for folks that are on the lower end of the earnings curve, people that are making like $20,000 a year, basically folks in that situation, and I've been there myself at times in my life, are just scraping by. They're making just enough to meet their living expenses. And so Vanguard, rightfully so, is saying folks in that category need to replace almost 100% of their pre-retirement income because it's just getting by. And that makes sense, right? But let's keep going on this. So
they're using something called, what percent can you replace based on normal savings rate? And then what percent do you need to replace? And then they come up with the gap. So Vanguard would say your retirement savings is going to help close the gap. Your Social Security is going to help close that gap, and any pension that you might have. And Vanguard is saying for folks that are making about $20,000 a year, they can replace about 2/3 of their income with whatever savings that they've put away before they retire, and then with Social Security. So Vanguard says they can replace 2/3 of their income, but Vanguard says, you know what, you're going to need to be able to replace 96% of your income. So they come up with this gap between what you need to be able to replace, which is 96%, and what you can replace, which is 2/3. And that gap for this group is 30%, right? And then they look at the next category. They jump up to the next category at $40,000 a year. And I'm simplifying this report. I'll leave the link in the show notes if you want to see the report and look through it yourself. Frankly, I'd be going through that report here if they had some pretty graphs. But frankly, the graphs and the charts are pretty dry, and I don't think you'd enjoy going through it in the video. So high level, I'm just going through these details. Okay. So people making $40,000 a year, Vanguard says, you know what? You can replace half of your income. Now, why can they only replace half of their income? It's because when you're making more money, you have lifestyle creep, and you're used to some things beyond just the basic needs. So Vanguard says, in general, folks can replace 50% of their income, but they're going to need to be able to replace 85% of their income. So according to Vanguard, you're actually worse off if you're making $40,000 a year than if you're making $20,000 a year. Now that should be your first giveaway that, not all is as it seems here. So the gap in that case, Vanguard would say, is 35%. Remember, the gap at $20,000 a year salary was 30%. And that's a big gap. Both of these are big numbers. Now, for folks that are making close to the median household average in the United States, which is $60,000, Vanguard estimates that between their retirement savings, their Social Security, and any pension that they might get, that those folks can replace 66% of their pre-retirement income. And Vanguard estimates that most of us to retire comfortably are going to want to replace 68%. So guess what the gap is there? It's 2 percentage points, right? So now this gap is closing. But in order to fully replace your pre-retirement income and the lifestyle that you've gotten used to, Vanguard would say you need to make $175,000 a year for a household. Well, guess what percent of American households make $175,000 a year or more? Not many. It's less than 15% of U.S. households make that kind of money. So according to Vanguard, only 15% of Americans are going to be comfortable in retirement. Again, I'm calling bunk on this. And I think it's one of the challenges in my industry is I think we unnecessarily scare people and tell people they need to save money. Save more money than maybe they need to. And the reality, obviously, in retirement, having access to more money is better than less. But the reality is we're humans and we're going to adapt when we're in retirement. So, if you're not quite where your financial advisor says that you need to be, maybe your financial advisor says, you only have a 87% likelihood of living a comfortable retirement and not running out of money. Maybe they've done a Monte Carlo for you. And maybe the financial advisor would like to see you at 97% confident, right? None of this is financial advice, but as a fee-only financial advisor myself, I can tell you I want my clients to have as high of a level of certainty that they're never going to run out of money, right? That's a good thing. But it doesn't mean you can never retire because you're not at that 97% certainty. And so that's where I want you to be careful. Okay, back to Vanguard study where they say you need to be making $175,000 a year in order to have a comfortable retirement. You need to be in the top 15% of all Americans. They would say those folks can replace 85% of their pre-retirement spending from their retirement sources. And Vanguard would estimate that they're going to need 43%. So in this case, instead of having a gap that they need to fill, they've got a positive gap, which is what we all want. Okay, so if you do believe this study, and whether you do or don't, what are some things that you can do if you feel that there's going to be a gap, right? And so there's a couple things shared in this study. One is, if many of us, 2/3, close to 3/4 actually, of people at 65 are homeowners, and about half of those people own their house free and clear. There's no mortgage on their house. And so one of the things Vanguard says is you can access some of your home equity. And if you do that, you close that gap by about 3 percentage points. Remember those, it's basically anywhere from zero gap to about 35% is what the gap is that we're looking to close. So Vanguard says, hey, one thing you could do is you could access some of your home equity. I don't think many of us want to do that. Okay, another thing you could do is you could reduce your cost. Yes, of course. We're human. We adjust based on our situation. So that's a no-brainer. Another one which I want you to be super cautious on, because I think it's three of the most dangerous words in financial planning and retirement planning, which is just one more year. I guess it's 4 words. Just one more year. You can work one more year. But you know what? Vanguard's already assuming that you retire at 65. And none of us are getting any younger when we're 60 or 65. And remember, if you're 60 years old, you likely have less than 1,000 weeks at 60 of healthy, active time remaining. That's not a lot of time. And you know what's likely going to be your healthiest and most active of all of those years is that first year. So don't trade away that first year without thinking about it. That's a big decision, and I want you to treat it like that. Okay. Another thing Vanguard says is you can increase the risk of your investment portfolio. A lot of people, this is not financial advice. I encourage you to work with a fee-only financial advisor, particularly to get this asset allocation right, because it's so important. How much risk that you're taking in retirement. Because what's worse than having a gap of a couple percentage points, what's worse than that? And that's having a gap of 20 or 30%. Because you blew out of your long-term asset allocation because the market got scary. I don't want that to happen to you. So please work with a professional, figure that out, find out what the right asset allocation is for you, because you don't want to find out on that dark, scary night when the stock market's down that, I took too much risk. So Vanguard says one of the things you can do to close that gap is to take more risk in your investment portfolio. Theoretically, that's true, but in practice, I discourage you from thinking about that. Okay, another thing that Vanguard points out as a caution is that Social Security, the inflows, the money into Social Security, according to Janet Yellen, who heads up the Social Security Trust, the board of trustees for the Social Security Fund, Janet Yellen says the inflows from American taxpayers and our employers is going to be insufficient to fund all the outflows as of 2034, which is very quickly approaching less than a decade. That doesn't mean that we're going to not get our Social Security checks, but maybe they're going to be less. And according to the Vanguard study, if Social Security gets cut by 25%, which is what Yellen is saying, the match between what the inflows are and the outflows, to match those up again, we'd have to cut benefits by about 20% if politicians don't do anything between now and then. According to Vanguard, that's going to increase your gap by about 10 percentage points. So that has a big, big impact. Unfortunately, Americans are getting scammed out of over $10 billion a year, and the vast majority of these scams are targeting people in their 50s, 60s, and older. Why? 2 reasons. One, we have more money to get scammed out of,
And second, with all this new technology, it becomes harder and harder for everybody to keep up on the technology. In fact, one of the safeguards for cybersecurity, some called two-factor authentication, where we get text a message, is one of the leading causes of large scams. And I'm talking people getting scammed out over $100,000. I don't want to see that happen to you. So let's go for a walk and let's talk about this. So, you know, our cell phones are wonderful things, but they also make it easier than ever for crooks to try to develop a line of communications with us. And it can be as simple as, you know, we get emails now. We've all heard the term phishing, where somebody tries to get you to click on a link. And once you do that, then bad things happen. So that's called phishing, phishing. But there's also something called smishing now. In the smishing, instead of phishing, the SM stands for SMS, which is the technical term for our text. So be careful with any links. I think we're all seeing more and more of those. We're also seeing what appear to be text by somebody that maybe is trying to contact a friend, and you know, our human nature, particularly in American culture, is to say, hey, you know, I'm not Janet. I'm not the person that you're trying to text. I thought you would want to know, but don't do that, because that opens up a line of communications with you and possibly people that do not have your best interest in mind. So that's smishing. But I want to go back to this two-factor authentication that is causing challenges and, frankly, causing some people to lose hundreds of thousands of dollars. And the banks are saying, you know what? You gave away this code to somebody else, and therefore you did not protect your account properly. And unfortunately, the banks are saying you're on the hook for that. So here's what happens. You get what looks like an alert from your bank. You know, maybe I'm just going to name, Bank ABC. Let's say you bank there, and they send you a text and say, hey, did you approve this $100 charge at Amazon or whatever the case is? And you say, no, I didn't. And then all of a sudden you get a phone call, and it's the caller ID says ABC Bank. And they say, hey, thanks. We just sent you that warning. Thanks for verifying that purchase was not yours. You know, we need to lock down your account. So first I need to verify, the bank, need to verify that you, the victim, are who you say you are. So they send you a text and say, give me the code so I can verify that you are this person that you say that I'm talking to. And unfortunately, when you give them the code, that's really a code from that bank. In my example, Bank ABC, it's really a code giving them permission to take money out of your account. And so that's what they end up doing, is taking money out. And the bank's going to say, hey, you gave them that two-factor authentication code, right? They have some information on you. They're trying to get into your bank account. Your real bank sends you a code saying, hey, somebody's trying to get into your account. Is that okay with you? Here's the two-factor authentication code. And if you give that to somebody, now you're on the hook, because that's like giving your password to somebody. And the bank's going to say, you should not have given that two-factor authentication code. So, and then oftentimes what happens is they call back and say, okay, we're going to send you a new credit card, or we're going to send something to you by FedEx. And then the next day they call you again and say, hey, you know, we just heard back from FedEx or whatever the delivery service is, and they cannot deliver the package to your house. I need to first verify you are who you say you are again. Here's the code. You share it with the scammers, and guess what? They're taking more money out of your account. This is another withdrawal. So the internet is just filled with cases like that. So I want you to be aware of it, because it's an easy way to lose a lot of money very quickly. Think about how many years it took you to save $100,000. And these bad guys, these scammers, can get it in a matter of minutes. And there's not a lot of protection that you have. In fact, in one case on the internet, one of the big banks, I'm going to read you exactly what they said. And this is a quote. I'm not going to identify the bank, but this is a quote. You did not take appropriate steps to protect your account from theft or unauthorized use. Can you imagine if you got that letter in response to somebody taking $100,000 out of your account? I mean, that would devastate a lot of us. I don't want to see that happen to you. I also want to share some other scams that people are being subject to lately, and what I think we're going to see a big increase of in 2024. I already talked about smishing, where instead of sending you a bogus link to your email, they send it to you on your phone. Oftentimes, these can look very legitimate, so be super careful. I do want, before I leave the previous scam, I should have mentioned, if you get a code, a two-factor authentication code, and somebody is asking you for that code, just hang up right away. And importantly, on the back of your ATM card, on the back of your credit card, will be a phone number to call your credit card company directly. Call them, see what's going on. I don't want to see it happen to you. Another way that people are getting hurt and losing real money is when they go to the ATM machine to withdraw money. Crooks, scammers, bad guys may have put glue in the little card slot where we put our card in for it to be read, because now our phones have, where you can tap to get access to your, you can tap to get access to your account. And what happens is, when you physically put in your card, when you take it out, oftentimes that's part of the process of shutting down your account so that the person behind you in line can't take money out. But when you tap, right, your card's not in the machine. And therefore, you have to manually say, this is my last transaction, close it out. And because that's something new, right, these tap credit cards are something that many of us are getting for the first time in 2023. So scammers are putting glue in the card slot so people cannot use the card slot. Then they're using the tap. Now, you still got to put in your code, but there's somebody watching. There's somebody watching your code where they can put in the code again for the next transaction. And it's all too easy to happen, particularly, on a busy weekend. Another thing, there's these apps now. Many of you have heard of Venmo. Many of you have heard of Zelle, where it's a way to send money to somebody. And so on places like Facebook Marketplace, and other online services where you can pay for goods and services, people are getting scammed. They're paying for things that are supposed to get shipped to them and never do get shipped to them. So just be super careful. You work hard for your money. It's your money, and I want to see you keep your money. One way to protect yourself from that is to do all your transactions directly through the platform as opposed to sending a payment directly to somebody. This way you have some protections.
That's 59 years old and they have $1 million. And their question is, do we have enough money to retire? And one of the things my viewers love about these deep dives is I'm not using $10,000 a year software, professional software. Instead, I'm using a free online tool that you can follow along with as well. I'm not sponsored by this tool. I just think it's a good tool and I want you to know about it. So let's jump in as I open up the tool here. And you can see we've got the couple here. They've got $1 million of savings and they want to retire at 60. They both turn 60 very, very soon. January of 2024 is when they turn 60. They have a life expectancy of 90. Because they're retiring, I have their annual income of 0, and their Social Security is going to come in total between the two of them at $4,000 a month, and they're going to wait till full retirement age before they start that. Again, they have a life expectancy of 90. I'm assuming that Social Security is going to grow at 3% a year. I'm assuming throughout this that inflation is going to be 3%. But you know what? You can change all of this and use the assumptions that you want to use. Okay, let's go to the next page. The next page looks at the portfolio. Here they've got $1 million and their portfolio is 50% stocks and 50% bonds. Now stay with me because I'm going to show you the results here in just a little bit. Their expenses, we're starting out with them spending $100,000 a year total, and that includes the money from Social Security once they reach full retirement age, which for them is going to be 67. So at first, all
all of the money, all of their living expenses is coming out of their account. I'm assuming that half of their portfolio is going to generate taxable income. So that would be money coming out of like a regular IRA or a regular 401k. Now, to the extent they have Roth IRAs or Roth 401ks, that money is going to come out tax-free, as will any money that they have in the bank because they've already paid tax on that. The taxable portion of their retirement income is going to be at 85%. And generally, somebody in this category, 85% of their Social Security, once they start taking it, is going to be considered taxable income for them. And I have an effective tax rate of 20%. Okay, now some people will say 20% seems high. Some people will say 20% seems low. Let's go to the next page where I look at income brackets. Here you can see, the 10% and the 12% income bracket in the income levels, the taxable income that you can have. It's important. Now, I'm not an accountant, and this is not financial advice. This is a great tool to give you directional ideas. I wouldn't retire using just this tool. I would hire a professional. But I want you to look at this income brackets and then the standard deduction, because there's a difference between what you get paid and what your taxable, your adjusted gross income is going to be. And these days, the standard deduction is quite a bit higher. And so the average married couple, you can see here in 2024, they're going to be able to deduct the first $29,200 of their income. So the first $29,200 above adjusted gross income, where then you subtract that standard deduction, that first $29,200 is not going to be subject to federal income tax. Again, not financial advice. I'm not an accountant. But essentially, if your AGI is zero, you're not going to owe the government any money. Okay. So again, I'm trying to address why I chose 20% in this first cut. Stay with me because we're almost to the answer to the question, do they have enough to retire? Okay, the next one is our capital gains tax bracket. A lot of people don't think about, there's really two tax systems in the U.S. There's one for ordinary income and then there's one for capital gains. And on the capital gains side here, you can see that for a married couple filing jointly, they can earn $94,000 until they start getting taxed at the long-term capital gains. But that's AGI. So really they have close to $30,000 above that. So over almost $125,000 of long-term capital gains they can take before they have to start paying taxes. Again, talk to an accountant. Okay, let's look at expenses. Here you can see I've got $8,333 a month, which comes out to $100,000. So really the question is, can somebody with $1 million about to turn 60, husband and wife, can they take out $100,000 a year before they start taking Social Security? And what does that look like? Now, this model takes into account that it's 67, full retirement age for them. They're going to start taking Social Security. So here's the results. And that dark line is the median. And again, the median is half of the people do better, half of the people do worse. This is what's called a Monte Carlo simulation. And you can see they ran 10,000 different scenarios. And these models use actual stock market data, but then randomize when those monthly returns, when those quarterly returns, or when those yearly returns happen. So essentially, they're trying to simulate for you 10,000 different lifetimes. Some of those are going to be very fortunate. You're going to end up with a lot of money, and some of them are going to be unfortunate. And that dark line is, think of it, out of that 10,000 cases, that's the 5,000th life, if you will. Half of those cases, you have more money than that. Importantly, you see they ran out of money at 72 with this model. Now, few people are going to be comfortable with that. So let's go back. This is the power of having a model. Let's go back and let's tweak the expenses. So instead of $8,333 a month or $100,000 a year, we're going to lower that down to $6,000 a month, $72,000 a year. And that's the only thing I've changed. In here, you can see that the median went from, in the previous model, the median was at 72. So we get an extra 10 years. Now the median case runs out of money at 83. And in some of the cases, if you're very fortunate, you're not going to run out of money. You're going to get to 90. And in this case, this person has $150,000 left. So not a whole lot. I would say a fourth of the people, maybe a third of the people would be comfortable with something like this, getting to the median case of 82. And the reason they'd be comfortable is you just don't get to 82 and say, oh my goodness, I'm out of money. You start to see what path you're on. Are you in one of the super lucky paths where the market does really well when you first retire? You can see here, when they first retire, the value of their account, even though they're taking out almost $75,000 a year, the value of their account keeps going up, right? In the very top, in the early years there. But again, certainly not half of the people would be comfortable with this. So let's go and tweak some more things. Okay, so now this time I'm leaving the expenses at $6,000 a month, but I'm coming in here and I want you to see that I've tweaked the stock allocation from what was 50% stocks and 50% bonds to 70% stocks. Now, this is not a portfolio for people that are faint at heart. This is going to be a volatile portfolio. You're going to feel it, but let's see what the impact is of simply, I say simply, it's probably one of the hardest things you can live through, of simply changing the asset allocation. Okay, if you see here, the median case goes to almost 83 years old. And in the best case, they die right at the top of that arc at 90. They almost have that full $1 million still left, just a tad under $900,000. And if they were unlucky, it would be 76. Now, I want to point out something that you see on the screen here. See how when they're about 67 years old, look at how their portfolio just plummets, right? It goes from $1 million down to, what are we at? 600,000 in a very short period of time. What is that? Certainly under 10 years. Like in 5 years, it goes from almost $1 million and then comes down in that steep decline and touches $600,000. That's a 40% drop. And that's the kind of thing you can get with a 70-30 portfolio. So again, doing something like that is not for the faint at heart. Okay, so instead, what I'd rather see people do is cut back on their expenses and not take an asset allocation that is going to cause a lot of stress. And the reason I encourage you not to take an asset allocation that is going to expose you to a lot of volatility is that's when people blow out of their long-term allocation. That's when they make a change, but they tend to make a change, obviously, when things are scariest and the stock prices are low. And then they're locking in those losses. I don't want to see that happen to you. I think better, let's lower the expenses. So let's go to the expense tab here. And we're lowering the expense down to $5,000 a month, $60,000 a year. And you can see here, now I've still got it at 70-30, but you can see here, boy, what a difference that makes, right? In this case, the worst case scenario is they run out of money a little after turning 82. The median case has them passing away, the dark line, the median, has them passing away with $500,000 still left that they can give to their heirs, to their kids, to causes that they care about. And if they get really lucky, look at that, they pass away with almost $3 million. So again, what I want to do here is I don't want you taking too much risk. So in the next portfolio, what I'm doing is I'm keeping the people spending $5,000 a month, $60,000 a year, but let's dial down the volatility of this portfolio. Let's take it back to a 50-50 stock portfolio. Now, I need to share that some people in my industry would say, hey, Azul, that's very conservative. Some people would say that's not conservative. And there is no blanket right answer. I do think there's a right answer for you. And that's the allocation that you're going to be able to stick with in both good times and bad times. And you've worked really hard your whole life. You really don't want to have a lot of sleepless nights. So if you feel like you're on the edge of your comfort zone, I strongly encourage you to rethink that. The other thing I'll share is as we get older, it's just natural for all of us to become less risk seeking, to become more risk adverse, for the down days in the stock market to hurt a lot more. You know, I have this conversation with people when they retire, particularly people that have lived their whole life with 100% stock allocation, and they want to stay that way. And one of the things I share with them is you're going to look at volatility, you're going to look at risk differently, because for some people, having money in their investment account is really a way of keeping score. It doesn't keep them up at night when they lose money. But you know what? Once that's your entire nest egg for the rest of your life, it feels a lot different if that account is down 20, 30, 40%. And as a reminder, in 2008, 2009, the great financial crisis, top to bottom, the S&P 500, the largest companies in the US, that was down almost 60%, peak to trough. 57%, I think, is where it is. That takes your breath away. That's a feature of the stock market. It's not a bug. Is something like that going to happen again over the next 30 years? I don't know. 20 and 30% moves is just what the stock market does. So be ready for that. So again, I've taken the asset allocation back to 50-50. Let's go back to the portfolio. You can see the stock allocation is 50%. In this case, they're spending $60,000 a year, and I've dialed back the volatility. So the median case is they pass away with $400,000. You can see now in the worst case scenario, they run out of money at 84. And in the best case, remember in the last one where they were 70% stock. In the best case, in that situation, they had $3 million. Here, they only have $2 million. So this looks like an outcome that a number of people would be comfortable. Again, I don't know your situation. This is not financial advice. But even with this, I want to point out that at 63, so when they first retire, the account starts going up. They feel really great about that. Right around 62 or 63, look at the drop. It goes down until they're about 67, and that drops down, let's call it $750,000. That's the kind of move that will keep some people up at night. So think long and hard about your asset allocation. I want to, again, have you think long and hard about working with a professional. You don't want to use a free online tool to decide whether to retire, but it can let you know whether you're in the ballpark. And I promised at the end, I was going to share with you what the name of the tool is. It's honestmath.com. I'm not affiliated. It's not sponsored. The stock market just hit another all-time high. And that's great to see, and we all celebrate it. But it's also a great time to look at our asset allocation, to look at our investments, and to make sure that we're on the right path. And in today's video, I'm going to share with you 3 things that I think you absolutely should do when the market's at an all-time high like it is right now. The first one is I implore you to critically look at your asset allocation and really ask yourself, do I have the right mix of stocks and bonds? Unfortunately, a feature of the stock market, while it's at an all-time high today, probably sometime in the next 10 or 20 years, it'll hit a scary low. It'll go through a big correction. Hopefully not, but probably yes. And the time to look at your asset allocation and to make sure you're not overexposed to stocks, to make sure you're not overexposed to equity, to make sure that you can withstand scary days when they happen again, not if, but when. I don't know the date, but it's just a feature of the stock market. I know it's going to happen. There will be another scary period. And the time to ask yourself, am I over allocated to stocks? The time to ask yourself that is when your stocks are at all-time highs. And if you do make a change, you're making a change and you're taking chips off the table at an attractive price. One of the secrets to being a successful long-term investor is avoiding being a forced seller in a down market. You don't mind being an educated and a patient seller in an up market. And that's what you have the opportunity to do today. So the first thing that I'd like you to think about is your asset allocation, and do you have your asset allocation correct? The second thing that I want you to think about is when stock prices are high, to the extent you have any charitable intents, there's charities that you like to support, this can be a great time to open up a tool that's called a donor-advised fund. And a donor-advised fund is custodians like Schwab and Fidelity offer tools like this. It's a special account where you can gift appreciated stock into this special account. You get your charitable write-off, but you don't have to decide where that money is ultimately going to go. You get to separate those. Now, it has to be an official charity. It has to be a recognized by the IRS as an official charity. Most churches, religious organizations are going to qualify. Things like the Red Cross are going to qualify. Many of the donations that we all make are going to qualify, but you can talk to Fidelity, you can talk to Schwab about that. But the advantage of gifting appreciated stock that you've held over a year, and that's important, so that it gets long-term capital gains treatment. It has to qualify for long-term capital gains, or instead of you getting the charitable write-off for the full market value of it today, if you've held that position less than a year, if it doesn't qualify as a long-term capital gain, you can only write off its cost basis. Now, this is not financial advice, and I'm not an accountant. So you should definitely see an accountant and make sure that how these rules are going to apply to you. But a donor advised fund can be a very powerful tool, and it's even more powerful when stocks are at highs. So, and I'm going through this list. The first one, making sure your asset allocation is super important. The donor advised fund is not going to apply to everybody, right? If you're not currently making charitable donations, if it's not something that's on your radar screen, you do you. This channel doesn't make moral judgments as to whether we should make donations to charities or not. But for those of us that are, a donor advised fund is something that a lot of people don't know about. You should know about. And the value of donating appreciated stock is worth more when the stock price is high, right? Because just the value of it's high. And also, it would be a shame for you to sell that position, for you to pay tax on that position, and then donate cash. When you can donate it to the charity, and if it's a charity that's recognized by the IRS, the charity can sell it without paying any tax on it. So a lot of folks are going to find themselves in the 15 or the 20% tax bracket with appreciated stocks by the time they figure out federal and state. So if you have $100, you might only be donating $80 to the charity after taxes. Where if you donate the appreciated stock directly to the charity can sell it, and now they have $100. So that's why it's so powerful. And then the donor advised fund lets you take advantage of opportunities like we're in now, where the stock market's at an all-time high. You can take advantage of that, even if you don't know who you're going to give that money to or how much you want to give to that charity. And you can separate these by years. So it's a super powerful tool. I want to make sure you know about it. Another super powerful tool is we talked about making sure your long-term allocation is right. But oftentimes, even if your long-term allocation is correct, let's say you were 60% in the stock market, 60% in the stock market, 40% in bonds. Well, when the stock market does well, you might have more exposure to stocks now than what you thought you did. So it's important that every year you look at it and you rebalance your stocks and bonds just to make sure that it's staying in the general area, the general percentage that you want it to stay in. So getting that right, it's very easy in good times for you to be over allocated to stocks. And then in bad times, just before the market's going to start going up again, because the value of your stocks went down, you're under allocated. Okay, so that's three things. I'm going to give you a bonus. Again, none of this is tax advice. I just want this to be on your radar screen. The next one is kind of taxy. So I really do. This is just put it on your radar screen. You research it on your own. But that is the limit for long-term capital gains, how much money you can make and still not be paying taxes on long-term capital gains. For a couple that's married filing jointly, your adjusted gross income can be a little over $90,000 a year and not pay any tax, federal tax, on long-term capital gains. And if you look at the standard deduction for a couple married filing jointly, that's like $30,000. Remember, the $90,000 limit is on your adjusted gross income, which is your
your salary less your deduction. So a married couple can make a little over $120,000 a year. Take that standard deduction, which brings your AGI down to $90,000, roughly. I'm just giving rough numbers here. And let's say $10,000 or $20,000 of that income was long-term capital gains. Well, you're going to get that for free. So without paying federal income tax. So look at the tax brackets, talk to an accountant about your situation, and you might be able to actually harvest long-term capital gains when you're at the 0% bracket. So it's something definitely worth talking to your accountant about. It's also worth watching this video here where I talk about 5 reasons to retire as soon as you can. You're working hard for your money. I want you to enjoy it. So I'll see you in this video. Thanks for watching this one. Bye-bye.